Hello friends. Often, a few days before the exam, we look for a quick revision videos on the various chapters covering the basic concepts of that chapter. So here I am with a quick revision video of the chapter Introduction to Accounts. In this video, we are going to cover a few basic terms including sales, debtors, capital, drawings, etc. Then, we are going to look at the meaning of accounting equation, the objectives of accounting, the functions of accounting, limitations of accounting, subfields of accounting, and last, the difference between bookkeeping and accounting. Hope this video helps you in doing a quick revision of the chapter. If you like the video, do share and subscribe. So let us begin with the revision. So let us begin with the few basic terms. Now suppose that Amar had started a business of trading in fancy dresses. Now, for this purpose, this business was started on say 1st January 2019. So, he brought in cash from his own pocket of 5 lakh rupees for the purpose of his business. This was Amar's personal investment in the business. Now, for trading in fancy dresses, he will first have to buy those dresses. So, from the 5 lakh cash he had, he purchased, he bought dresses worth rupees 1 lakh rupees with cash and dresses worth rupees 50,000 on credit. Credit means that he told the supplier that he will pay for this material at a later date. Say, payment will be made after 3 months. So he still has 4 lakh rupees cash remaining with him. He also bought an office space and pays rent of 10,000 per month for that space. Now he sold these dresses costing rupees 10,000. So for now he has total dress of 1 lakh 50,000 rupees. Out of these 1 lakh 50,000 rupee dresses, he sold the dress costing 10,000 for rupees 15,000. That is 5,000 extra. So for now he has cash. He had brought in 5 lakh from his pocket. With 1 lakh rupees he bought the dresses and he sold 10,000 rupees clothes for 15,000 rupees. So he received 15,000 cash. Also, he paid a rent of 10,000 for the month. So, he had a cash balance of 4 lakh 5,000. He will have stock, that is fancy dresses. He had bought 1 lakh 50,000 worth of clothes, out of which he sold 10,000 worth. So, he will have 1 lakh 40,000 worth of fancy dresses in his godown. Now, He also has to pay to the supplier 50,000 rupees after 3 months. If we do a quick summary of all these transactions, he has sold dresses for 15,000 and the cost of the dress was 10,000, so he has earned 5,000 extra, but he has also paid rent of 10,000 rupees for the purpose of his businesses, so 5,000 extra expenditure has been done by him on the firm. Now let us look at each and every transaction and understand the meaning of the terms associated with accountancy. First of all, he brought cash worth rupees 5 lakh in the business. This is his capital. So, capital is the owner's interest in the firm, the money that he has brought in from his own capital, along with any profits or losses that he will earn in the future. Then he bought dresses worth rupees 1 lakh with cash and 50,000 on credit. So, this is known as purchases. He paid rent worth rupees 10,000 per month. So, this rent is an expense incurred for the firm. He sold the dresses for 15,000 rupees. This is known as sales. Now, 50,000 worth of dresses were bought on credit. That is, he will have to pay the supplier after 3 months. So, there is an obligation on behalf of Amar. This is known as a liability. Now, the supplier, that is the person to whom we owe the money, is called the creditor. Now, since we had bought goods worth rupees 1,50,000 and sold only 10,000 worth of goods, fancy dresses will be lying in the go down. This is known as my stock or inventory. Now, cash and stock. Both of these commodities belong to Amar. He owns an interest and he controls these two property because of an action in the past. That is, he purchased the stock and he bought in capital from his own pocket into the firm. These two are known as assets. By selling the stock for 15,000 rupees, he earned 15 sorry by selling the stock he earned 15,000 rupees. This is known as the revenue or income. Now he sold that stock for a 5,000 rupees profit. So this is a profit. But we see that he had also incurred rent worth rupees 10,000, because of which he has both this purchase and rent is an expense for the business. So in this case, the expense is 20,000 rupees, which is exceeding the sales amount of 15,000, giving us a net loss. So 5,000 is a loss, that is the excess of expense over the revenue. Now, all these exchanges, such as purchase of goods for 1 lakh rupees, paying office rent of 10,000, these are known as transactions. So transactions are exchange of goods and services for a consideration. For cash, Amar was able to buy clothes, so he had exchanged his cash for obtaining dresses from the supplier. Now suppose he makes a further sale of 10,000 rupees for rupees 14,000. The person to whom he makes the sale says that he does not have enough money at the moment and shall repay him, say, after 2 months. So, since Amar did not receive the money then and there for his clothes, he has received a promise to get the cash in the future. So, the person to whom he sold these goods will become his debtor. So, debtor is any person who owes the firm some money or other consideration. So, we've seen what a transaction is. A transaction is an exchange of goods or services for cash or other consideration. An asset is a property in which the firm owns an interest. A liability is an obligation, it is a financial obligation to pay in the future. The profit happens when the revenue is more than the expense, and a loss is incurred when the expense is more than the revenue. Stock is anything that is held in the business for sale in the ordinary course of business, that is, in this case, the fancy dresses. Next, purchases is where we buy a commodity or a goods or a service in exchange for a consideration. Sales is when we sell the goods to a third party for obtaining cash or other assets. A debtor is a person who owes us money. A creditor is a person to whom we owe money. Capital is the owner's interest in the firm. It is what the owner has brought into the firm from his own personal account. Revenue is the income generated out of sales. Now suppose we had 4,05,000 cash. So out of this, Amar was in need of cash for some personal use, so he withdrew 50,000 rupees for personal use. So this is known as drawings. So drawings is when the owner withdraws amount or an asset from the business for his own personal use. So transaction is exchange of goods or services for consideration. Example, paying rent, purchase, etc. A creditor is a person to whom an amount is owned by an enterprise on account of goods purchased or services received. Debtor is a person from whom amounts are due for goods sold or services rendered. Purchase means to take possession of a given asset by paying a predetermined amount of money for the transaction to be completed successfully. Sales is the operating revenue earned by a company or an entity for selling its product or rendering its services. Drawings is the amount of goods or service which is withdrawn from business for personal use. Capital is the amount invested in an enterprise by its owner. Profit is the excess of revenue over expense, and loss is a vice versa, that is, excess of expense over revenue. Liability is the financial obligation of an enterprise other than the owner's fund. Owner's fund is nothing but the capital. An asset is a property or economic resource of an enterprise which can be expressed in monetary terms. Stock is an asset held for sale in the ordinary course of business or is in the process of production for such sale or in the form of materials to be consumed in the production process, or rendering of service. Now let us look at what is an accounting equation. So every transaction has two effects. Say, when we bought dresses with cash, there was a cash outflow in this transaction and a stock inflow. So there was a decrease in one asset, that is cash, and an increase in another asset, that is stock. When we bought dresses on credit of 50,000 rupees, there was an increase in stock, that is an asset, and there was an increase in the creditors, that is a liability. When we sold the dress for 10,000 rupees, then there was a reduction in the stock, that is one asset, because we had sold it, but there was an increase in cash, that is another asset, because of inflow of the sale proceeds. So we see that every transaction has two effects. It either increases one asset and decreases other asset, or increase one asset or decrease and increase a liability or a capital. This is actually the basis of accountancy. Every transaction will have two effects. So, if we express this concept mathematically, we get the equation that at all situations, assets will equal to the liability and capital. Now, asset is the total properties of the firm. Now, so this asset will either be financed by way of liability or by way of capital. Say you have assets, machinery, stock, cash, furnitures, etc. So these can be procured by one of the two ways. First, you have brought it from your own pocket, so it will be a capital if it is introduced by the owner, or you can take it on credit from a third party. Say you can take a loan or a creditor or such things. So the assets will either be financed by way of capital or by way of a liability. Capital is the owner's interest and liability is obligations to third party, and assets are the properties of the firm. This is a most fundamental concept of accountancy. All the balance sheets, PL, everything is based on this concept. So now we will look at the objectives of accounting. So why do we do this accounting? What are the objectives? First, say you have over here you had entered into a transaction. The first transaction was a purchase of goods. Then you paid office rents. Then you sold those goods for cash and on credit. So these are individual transactions. First, we record these transactions. So the first objective is a systematic recording of the transactions, which is done in the form of journals, ledger, and trial balance, which you will cover or you would have already covered in detail. So first we record these transactions. Now, these transactions are recorded as and when they occur. Say on 1st Jan, you bought the dresses, then you're going to record it in your books. The next day, you paid the office rent. That recording will be done on the second day, and so on. Now, towards the closure of the year, we have to calculate the impact of these transactions. That we sold goods for 15,000 rupees at an excess of 5,000 rupees, but we also paid rent of 10,000. So our total expense, that was 20,000, was more than the revenue of 15,000, because of which we got a result. That is a loss of 5,000 rupees. So the next objective is the ascertainment of result. We would obviously like to know that how much profit or loss we have made from our business. So for this, we prepare the profit and loss account. Now the third. Because of these transactions, you came in the possession of many assets and liabilities. You had assets worth cash worth rupees 4 lakh 5,000, stock of 1 lakh 40,000. You had a creditor of 50,000, capital of 5 lakh. So you will like to know at the end, if you want to know at a particular date, how many assets you have and what is the total liability of the firm. That objective is fulfilled by accounting. So, next is the ascertainment of the financial positions, that is, the amount of assets and liabilities of the firm. For this, we prepare the balance sheet. And last, in a firm or in a business, many people have an interest. For example, your customers, your shareholders, the owner of the firm, the suppliers, etc. So we have to communicate this result, the total profit or losses of the company, and the total assets and liabilities to the users of those information, such as suppliers, customers, etc. So next objective is communicating information to various users. This is done by way of financial reports, which every company publishes at the year end. So first, we'll record the transactions. Then, during the closure of the year, we ascertain what is the profit and loss of the company and how much asset and how much liability do the company have. Then, all these informations are communicated to the various users through financial reports and such other reports. Next, we have the functions of accounting. So, we know that there are two types of exchanges. One is an event, and second is a transaction. Suppose a key personnel dies, so with him his experience also goes away. It is actually going to have an impact on the business of the firm. So that is an important event. It affects the company, but you cannot express it in terms of money. So we do not record it in the books of account. So entries such as death of a key personnel or such qualitative aspects are not recorded in the books of accounts, whereas all transactions such as purchase, sale, paying rent, insurance, etc., are recorded in the books of accounts. So, first function is to identify, that is, what we are going to record and what we are not going to record. Now, once we have identified that we are going to record a transaction, say purchase of machine is a transaction, and we have to record it in the books. This we have identified. Then we have to decide at what amount we are going to record this transaction. So measurement is the next function. Say we bought the machinery, the cost price was 10,000 rupees. Then, to bring the machinery from the supplier's location to your own warehouse, you incurred a transportation charge of 2,000. You paid insurance for this machinery of 500 rupees. So we see that a total of 12,500 has been incurred on the machinery. So we are going to record this transaction in the books at 12,500. This is a measurement that is determining at what amount the transaction will be recorded. Identifying is what transaction should be recorded. Now third, we have decided that we have to record the purchase of machinery at 12,500. The next activity is recording that transaction. This is done in the form of journals. It is done in a chronological manner, that is, as and when the transaction occurs. Now, next, suppose in the month of April you paid rent of 10,000, then you will pay it in the month of May as well, then June, July, and so on till your year end of 10,000. So you've paid a total rent of 1,20,000 during the year. So on 1st April in your journal, you recorded this transaction of 10,000 rupees. Then you recorded it again on 1st May, then on 1st June, 1st July, 1st August, and so on till 1st of March. But all these transactions are of the same nature, that is rent. So you can say that in 1 year, we incurred a total rent of 1,20,000. So at the first instance, you recorded these transactions in the book on the date on which it occurred, that is 1st April, 1st May, 1st June, 1st July till 1st March. Next we do is classifying. So classifying means grouping all these individual transactions into one account and saying the total of that account. This is done in the form of a ledger. So rent is one ledger. At the year end, it will show a total figure of 1,20,000. Now, in your company or in your firm, rent is not the only expense. You will have an expense, rent, insurance, purchase, etc. So, in your firm, you have a lot of transactions. You have rent, insurance, purchase, sale, assets of machine, stock, liability of creditor. So you'll have separate ledgers for each of these transactions. For rent, you'll have a separate ledger, insurance separate ledger, purchase separate ledger. So during the year end or on a particular date, you might want to have just a glance of how much expense, how much income, how much asset, and how much liability. So we summarize all these transactions and show it in the form of a trial balance. By looking at the trial balance, you can see at one shot, okay, so rent is 1,20,000, insurance 20,000, purchase 2 lakh, and so on and so forth. So the next function is summarizing. This is done in the form of a trial balance. And last is communication. As we've already seen that there are many users who require information about the firm, so communication is done in the form of balance sheet, PL, annual reports, etc. So, the functions of accounting is first to identify what transaction to record, then determine at what amount the transaction has to be recorded, then actually recording that transaction in the form of journals, then the individual transactions of similar nature are classified and grouped in the form of a ledger. Then we summarize all the transactions to see at one shot how much expense has been incurred, of what nature, what all assets you have, and how much is the value, and so on, which is done in the form of trial balance. And last is communication of that information to various persons such as creditor, supplier, etc., in the form of balance sheet, PL, annual reports, and so on. Now we are going to look at the limitations of accounting. So accounting serves a lot of purpose. It tells you what is your profit and loss for the year. It tells you how much assets you have, how much liabilities you have, and so on. But it does have its limitation of its own. While you can record transactions that can be expressed in the form of money, such as purchase, sale, etc., but you cannot record, value of certain factors like loyalty, skills of the persons. These are qualitative aspects which cannot be expressed in the terms of money, and therefore the balance sheets and PL does not reflect the value of these elements. So first, it does not reflect value of certain factors like loyalty and skills. And we all know that these two are very important factors. With skills and experience, your business will all obviously progress more. Next, uh, so if we, as and when we go on with the subject, you see that there are many places where judgments have to be made. Suppose you have a debtor of 5 lakh rupees, and basis the situation of the debtor, you know that you will not be able to recover the entire amount because say you know that that person does not have enough money. So you make a provision for that amount. Provision means that you are saying that there is a doubt whether you will get the money or not. So you're kind of writing it off from the books. So that is an estimate. You cannot be sure. Maybe that debtor will pay you the entire amount. Maybe he'll pay you 50%, 20%, or maybe nothing. So it is based on the estimate. Now, because of that estimate, the profit and loss of the company gets affected a lot. So one of the limitation is that the accounting estimates, such as the provision for doubtful debts, depend on sheer judgment of the accountant, and so it can manipulate the profit and loss of the company. Next, as and when you go forward with the subject, you'll see that there are accounting standards which define different policies for the treatment of the same items, such as a stock valuation. So you can value your stock basis LIFO or weighted average method. Each of these methods will give you a different answer. So, depending on the methods that you adopt, your profit and loss will keep on changing. So, there is a scope of manipulation of your financial results. So, next limitation is different accounting policies for the treatment of same item adds to the probability of manipulation, such as stock valuation. Next, we are going to look at the subfields of accounting. So, primarily, there are three subfields. First is a financial accounting. The example that we saw in the beginning of the video is a part of the financial accounting where you record all the transactions, determine the profit and loss of the company, and present it in the form of annual reports and balance sheet and PL account. So, financial accounting covers the preparation and interpretation of financial statements and communicating it to the users of the accounts. Now, all the transactions that are recorded have already occurred. So, it deals with the historical transactions, historical amounts. So, it is historical in nature. It primarily helps in determining the net results for an accounting position period and the financial position as on a given date. So, it covers the preparation and presentation and communication of financial results, that is determining the net results for the period and financial position, that is the assets and the liabilities. Next, it is historical in nature. The second subfield is cost accounting. Now, company can be making three products. Say it makes product A, B, and C. The total revenue, say the costs incurred for each product is 10,000 A, 20,000 B, and 5,000 C. So the total expense will be 35,000. The total revenue from A is say 11,000, from B it's 25,000, and from C it's 1,000. So the total revenue for the firm is 37,000. If we see the individual profit and loss of the product, we have a profit in product A, in B, but a loss of 4,000 in product C, giving us a total profit of 2,000. Now, in financial accounting, we just represent that the total cost for the company was 35,000, total revenue is 37,000, giving us 2,000 rupees. But if you want to know what was the total cost for each individual product and how much is the revenue or profit or loss from each product, we do that in cost accounting. So, in cost accounting, we determine the profit and loss from each product or each division of the company. It helps the company, is mostly used by the internal management in decision making. It helps the management to decide, say, okay, C is not functioning, is not working very properly, so we might discontinue it. The market is not accepting this product. This kind of decisions can only be made on the data provided by cost accounting. So, cost accounting deals with cost ascertainment and cost control. It is a process of accounting for costs at different levels of production. It helps in cost ascertainment and cost control. Since it provides data for each and every product at each and every stage of production, we can identify where the costs incurred are huge and where we can avoid costs by streamlining the processes or improving the process. The last is the management accounting. Now, the financial accounting has given you that, say, the financial accounting has told you that you had a total expense of 35,000, total revenue 37,000, so a profit of 2,000 in 2019-20. If you wanted to go product wise, the cost details, cost accounting has told you that okay, you made a income, you had a profit of 1,000 in product A, 5,000 in product B, and a loss of 4,000 in product C. But these informations are not sufficient in itself. We can make decisions. Okay, now if I tell you that in 2016 2017 we had a loss, total loss of 2,000 rupees. In 2017-18 we had a profit of 500 rupees. 2018-19 a profit of 1,700, and finally in 1920 a profit of 2,000. So when we look at it this way, we see, okay, so we are having an increase in the profits of the company. This is a conclusion which a management has drawn based by comparing the current result with the previous year's result. This is a part of management accounting. We look at information from different views. We compare it with other companies, we compare it with the previous years, with other industries, etc., to determine that whether our processes are correct or not, where we can improve our process, what our competitors are doing that we are not doing. So, management reporting is concerned with internal reporting to the management. Outside parties are not interested in this data. It is mostly for the benefit of the management so that they can improve their processes and thereby increase their profit. It helps in functions of planning, controlling, and decision making. So we saw that there are three subfields of accounting. Financial accounting is where we get the total expense and revenue of the company, the profit, balance sheet, and the assets and liability position as on a given date. If we want to look at the costs incurred at different stages for each of the product or service or branch, we look at the cost accounting data. It gives more detailed information about the production process. And next we have the management accounting, where we compare the data provided by cost accounting and financial accounting with other industries, with previous years, with our competitors, etc., to analyze what is going wrong in our business, where we can improve, how we can improve it, and so on. The last topic that we are going to cover in this lecture is the difference between bookkeeping and accounting. In the times of our fathers and grandfathers, we did not have chartered accountants as such. Means there was more of a system of a munshi. You might have seen that if your parents had a firm, sorry, if they had a business, they used to employ the services of a munshi. The munshi was concerned with only recording all the transactions. So much detailed analysis as we do today in cost accounting, management accounting, etc. They were not formed. They were not a part of accounting then. This is a bookkeeping. So when we recorded the transactions in our first stage, which we studied in our objectives and functions, that is bookkeeping. So bookkeeping is simply concerned with the recording of transactions, whereas accounting is concerned with summarizing and presenting of recorded transactions. So we can say, so bookkeeping is the first step of accounting. Financial statements do not form part of bookkeeping, whereas financial statements are prepared in the process of accounting. Now, since bookkeeping is only concerned with recording the transactions, managerial decisions cannot be taken with the help of these records. But we have already discussed that accounting is not just concerned with recording the transaction, it goes much beyond. We determine the net results, we have cost accounting, management accounting, and so on. So, management takes decision on the basis of the accounting records. There are many more differences between bookkeeping and accounting. These are just the basic ones and the major differences between bookkeeping and accounting. With this, we come to an end of our revision video on Introduction to Accounts. I hope this will help you in revising this chapter in a quicker way. If you have further doubts, you can post them in the comment section below. If you like the video, do share and subscribe. Thank you.